Welcome to A to Z Forex weekly recap of the 2nd of February. Hi, I'm Gwen, a senior project manager at A to Z Forex, and for this week we have a closer look upon the QE plans of the ECB, but we also deal with the intriguing latest development on the market, which emphasizes a worrying outlook for Europe. To kick off, let me remind you about the mere fact that historically the majority of people preferred using gold-backed monetary structures, since central banks always tend to print more money. Well, it's just a matter of clicking a button and watch the magic happen. If you don't need any gold to back up your currency, right? We have seen the US Fed doing it. The Japanese have been doing it, and now it's finally the turn for the European Central Bank. While many of us were discussing 500 to 600 billion euro quantitative easing possibilities, the ECB announced a large-scale quantitative easing with double the expectations, namely a staggering 1.1 trillion euros, basically following after the footsteps of the US Fed, hoping for a US-like recovery. When assessing the ECB's quantitative easing program, we can conclude 5 main items. Starting off, the large-scale quantitative easing plan will be initiated on March 2015, and the program will run up for 18 months, until September 2016. Secondly, the QE will cover monthly bond purchases of 60 billion euros. Thirdly, 20% of purchases by ECB conforms with the balance of national central banks. Fourthly, the program aims to provide cheaper loans to banks in order to stimulate borrowing, hence stimulating the EU economy. Last but not least, one of the main KPIs set by the Governing Council is the 2.0% inflation rate. So to sum it up, is this what Europe really needed? Since this has been the primary question to start with. Was there even a fund shortage in the European banks? On these exact questions, Sabine Lautenschlager, a member of the ECB's executive board, shared her opinion that the European banks already had enough cash before the quantitative easing announcement. However, they were not lending due to their bad loan fears because of the weak regional economy. Moving along to the next topic of discussion, we pay a close look to the purpose of the QE plan, while also determining what we can expect from it. So from their inception, central banks always believed that they are responsible for keeping inflation in control, but no inflation means there is no economic development. This can be clearly seen when we assess the financial crisis back in 2008, when the central banks controlled the inflation rate by playing with overnight borrowing interest rates. In time of fear, they would reduce the interest rates, which would encourage banks to lend more, hence avoid the economy from falling into recession. Central banks would do the opposite, when inflation would go out of control. However, when in 2008 the crisis hit the world, leading central banks could not sustain their inflation targets by only cutting interest rates. They started to check for an innovative crisis management technique in order to encourage banks to pump up money into the economy. What other method than creating money that does not exist would appeal to these central banks? Therefore, quantitative easing was enacted. To be able to apply quantitative easing, central banks started to create money by purchasing government bonds and other securities from banks, with electronic cash that did not exist before. According to the theory, the newly created funds would increase bank reserves. Just like every other economic sphere, supply and demand equation would take control. Freshly pumped capital reserves would encourage banks to lend more, buy new assets, and would in return stimulate the economy. In short, QE aims to show how determined a central bank is to fight deflation and create confidence in the national or regional economy. In practice, the world has seen a number of QE attempts since 2008. After 3 rounds of QE in the US, the Fed managed to relatively stimulate the American economy, bring their unemployment levels close to their targets, as well as the inflation targets. Japan, however, has not been successful at implementing QE plans. In the UK, the Bank of England bought gilts from financial institutions along with smaller amount of relatively high-quality debt issued by private companies. According to IMF, global central banks' QE attempts since 2008 have contributed to reduction in systematic risk, but also the improvement in market confidence, hence avoiding deeper recessions. Even though the QE announcement made a staggering impact, currently all eyes are set on Greece. Even the ECB is intensively following the Greek developments and the possible Greek spills to other troublesome European countries, such as Spain or Italy. Syriza's victory in Greece already encourages those of similar parties to push more with their anti-austerity plans. Syriza declining to collaborate with Troika and demanding debt relief will ultimately become a big problem for Europe. It seems like the only one who benefits from these developments would be Russia, as any Grexit would lead Greek leftists collaborate with Putin administration who has been under strict sanctions due to the crisis in Ukraine. Therefore, it can be seen that at this moment ECB's QE program seems to become a little too late, while Euro will be under further pressure for the coming months. So, buckle up traders, as volatility is ahead. My name is Gwen and stay tuned with A2ZForex.com for more essential news.